Investing in theory. All investment returns, whether from common stocks or exceptional diamonds, are dependent, to varying degrees, on future events. That's what makes the fascinating of investing. It is a gamble whose success depends on an ability to predict the future. Traditionally, the pros in the investment communities have used one of two approaches to asset valuation: the firm foundation theory or the castle in the air theory. Millions of dollars have been gained and lost on these theories. To add to the drama, they appear to be mutually exclusive. An understanding of these two approaches is essential if you are to make sensible investment decisions. It is also a prerequisite for keeping you safe from serious blunders. Toward the end of the 20th century, a third theory, born in academia and named the new investment technology, became popular on the streets. Later in the book, I will describe that theory and its application to investment analysis. The firm foundation theory. The firm foundation theory argues that each investment instrument, be it a common stock or a piece of real estate, has a firm archer of something called its intrinsic value, which can be determined by careful analysis of present conditions and future prospects. When market prices fell below, rise above this foundation of intrinsic value, a buying-selling opportunity arises, because these fluctuations will eventually be corrected, or so many theory goes. Investing then becomes a dull but straightforward matter of comparing something's actual price with its firm foundation of value. It is difficult to ascribe to any one individual the credit for originating the firm foundation theory, as Elliott Guide is often given this distinction, but the classic development of the technique and particularly of the nonsense associated with it was worked out by John B. Williams. In the theory of investment value, Williams presented an actual formula for determining the intrinsic value of the stock. Williams based his approaches on dividend income. In a friendlish, clever attempt to keep things from being simple, he introduced the concept of discounting into the process. Discounting basically involves looking at income backward, rather than seeing how much money you will have next year, say $1.05. If you put $1 in a savings certificate at 5% interest, you look at money accepted in the future and see how much less it is currently worth. Thus, next year's $1 is worth today only about 95 cents, which could be invested at 5% to produce approximately $1 at the time. Williams actually was serious about this. He went on to argue that the intrinsic value of a stock was equal to the present or discounted value of all its future dividends. Investors were devised to discount the value of monies received later. Because so few people understood it, the terms couch on and discounting now enjoys popular usage among investment people. It received a further boost under the aegis of professional Leveling Fisher of Yale, distinguished economist and investor. The logic of the farm foundation theory is quick, respectable, and can be illustrated with common stocks. The theory stressed that a stock's value ought to be based on the stream of earning a firm will be able to distribute in the future in the form of dividends. It stands to reason that the greater the present dividends and their rate of increase, the greater the value of the stock. Thus, differences in growth rate and a major factor in stock valuation. Now, the slippery little factor of future expectations snakes in. Security analysis must estimate not only long-term growth rates, but also how long its extraordinary growth can be maintained. When the market gets overly enthusiastic about how far in the future growth can continue, it is popularly held on Wall Street that stocks are discounting not only the future, but perhaps even the hereafter. The point is that the farm foundation theory relies on some tricky forecasts of the extent and duration of future growth. The foundation of intrinsic value may thus be less dependable than is claimed. The farm foundation theory is not confined to economists alone. Thanks to a very influential book, Benjamin Graham and David Dodd's Security Analysis, a whole generation of Wall Street security analysis was converted to the fold. Sound investment management, the practicing analysis learned simply consists of buying securities whose prices were temporarily below intrinsic value and selling ones whose prices were temporarily too high. It was that easy. Of course, instructions for determining intrinsic value were furnished, and any analyst worth his or her salt could calculate it with just a few taps of the personal computer. Perhaps the most successful discovery of the Graham and Dodd approach was a Canadian Midwest named Warren Buffett, who is often called the Sage of Omaha. Buffett compiled a legendary investment record, originally following the approach of the foundation theory. The castle in the air theory. The castle in the air theory of investing concentrates on fixed values. John Maynard Keynes, a famous economist and successful investor, enunciated the theory most lucidly in 1936. It was his opinion that professional investors preferred to devote their energies not to estimating intrinsic values, but rather to analyzing how the crowd of investors is likely to behave in the future and how during periods of optimism they tend to build their hopes into castles in the air. The successful investor tries to beat the gun by estimating what investment situations are most susceptible to public cast, building and then buying before the crowd. According to Keynes, the foundation theory involves too much work and is of doubtful value. Keynes practiced what he preached. While London's financial men toiled many weary hours in crowded offices, he played the market from his bed for half an hour each morning. This leisurely method of investing earned him several million pounds for his account and a tenfold increase in the market value of the endowment of his King's College, Cambridge. In the Depression years in which Keynes gained his fame, most people concentrated on his ideas for stimulating the economy. It was hard for anyone to build castles in the air or to dream that others would. Nevertheless, in his book, The General Theory of Employment, Interest and Money, Keynes devoted an entire chapter to the stock market and to the importance of investor expectations. With regard to stocks, Keynes noticed that no one knows for sure what will influence future earnings, prospects, and the dividend payments. As a result, he said most persons are largely concerned not with making superior long-term forecasts of the probable yield of an investment over its whole life, but with foreseeing changes in the conventional basis of valuation a short-term time ahead of the general public. Keynes, in other words, applied psychological principles rather than financial evaluations to the study of the stock market. He wrote, "It is not sensible to pay 25 for an investment of which you believe the prospective yield to justify a value of 30. If you also believe that the market will value it at 23 months hence, Keynes described the playing of the stock market in terms readily understandable by his fellow Englishmen. It is analogous to entering a newspaper beauty judging contest in which one must select the 6 prettiest face out of 100 photographs, with the prize going to the person whose selections most nearly conform to those of the group as a whole. The smart players recognize that personal criteria of beauty are irrelevant in determining the contest winner. A better strategy is to select those faces the other players are likely to fancy. This logic tends to snowball. After all, the other participants are likely to play the game with at least as keen a perception. Thus, the optimal strategy is not to pick those faces the player thinks are prettiest, or those the other players are likely to fancy, but rather to predict what the average opinion is likely to be about what the average opinion will be, or to proceed even further along this sequence. So much for British beauty contest. The newspaper contest analogy represents the ultimate form of the castle in the air theory of price determination. An investment is worth a certain price to buy because she expects to sell it to someone else at a higher price. The investment, in other words, holds itself up by its own bootstraps. The new buyer, in turn, anticipates that future buyers will assign a still higher value. In this kind of world, a sucker is born every minute, and he exists to buy your investments at a higher price than you paid for them. Any price will do as long as others may be willing to pay more. There is no reason, only math psychology. All the smart investor has to do is to beat a gun, get in at the very beginning. This theory might less charitably be called the greater fool theory. It's perfectly all right to pay 3 times what something is worth as long as later on you can find some innocence to pay 5 times what it's worth. The castle in the air theory has many advocates in both the financial and the academic communists. Robert Schuller, in his best-selling book, Our Relation Ex Urbanus, argues that the mania in Internet, the high-tech stocks during the late 1990s can be explained only in terms of math psychology. At universities, so-called behavioral theories of the stock market, stressing crowd psychology gained favor during the early 2000s at leading economics departments and business schools across the developed world. The psychologists Daniel Kahneman won a Nobel Prize in Economics in 2002 for his seminal contributions to the field of behavioral finance. Earlier, Oscar Morgenstern was a leading champion. Morgenstern argues that the search for intrinsic value in stocks is a search for the real or the with. In an exchange economy, the value of any asset depends on an actual or prospective transaction. He believed that every investor should post the following Latin maxim above his desk. This is Latin language. I don't know what is exactly pronunciation. Leis tantum valet quantum landi potest. A thing is worth only what someone else will pay for it. Oh, next paragraph is the last one. How the random walk is to be conducted. With this introduction out of the way, come join me for a random walk through the investment woods. With an ultimate stroll down Wall Street, my first task will be to acquaint you with the historical patterns of pricing and how they bear on the two theories of pricing investment. It was Santayana who warned that if we did not learn the lessons of the past, we would be doomed to repeat the same errors. Therefore, in the pages to come, I will describe some speculator crises, both long past and recently past. Some readers may poo-poo the mad public rushes to buy thrift bulbs in 17th century Holland and the 18th century South Sea bubble in England. But no one can disregard the new issues mania of the early 1960s or the 1950s, craze of the 1970s, the incredible boom in Japanese land and stock prices, and the equally spectacular crash of those prices in early 1990s, as well as the internet craze of 1999 and early 2000, provide continual warnings that neither individuals nor investment professionals are immune from the errors of the past. So far we read the 1, 2, 3, 4 chapter. The first was the investing in theory. The second, the farm foundation theory. The castle in the air theory. The last one, how the random walk is to be conducted. See my opinion, so I just read the 4 paragraph, so this is hard to understanding all sentence. So we need to learn some history of economy, so America and all over the world. America or Europe, Japan, and many other Asia countries. And so I'm gonna study what was happened maybe some 90s, 90, 20, 1930s, 1940s, and so on. So we're gonna see the next chapter, the madness of crowds. Okay, see you soon.